And the area that we start on today is that on taxation. So that what I've done is to summarize the discussion which we'll have on taxation. And that summary Excel I've sent to your WhatsApp. If you check your WhatsApp, you'll get the Excel summary, yeah? So what I want you guys to do is to download that Excel because that will guide us on how to proceed, yeah? So kindly, let's have that downloaded so that thereafter we can proceed, yeah?
Okay.
Yeah, all right. So I think we can proceed. And that Excel that I've sent has a number of sheets down there labeled. We have a number of issues to discuss under taxation. The first Excel summarizes the subtopics of discussion. One is the administration of debt in county and national government, for which really there is not much about calculations. That's about something to read. It's about a read that you guys need to do. Yeah. In Kenya, the law that governs the administration of debt in both the county and the national government is in a document called the PFM, yeah, the PFM Act, yeah. Who has interacted with it? Who has interacted with it? Who has interacted with the PFM Act?
I have.
Anyone? The Public Financial Management Act, who has interacted with it? I'll not ask you a question. Anybody who has interacted with it?
Yes.
We have.
Yeah?
We have.
Oh, you have, yeah?
Yes.
This is who?
Peter.
Yes?
Peter.
Come again, I can't hear you.
It is a choky.
Oh, a choky you have, yeah?
Yes.
So
yes.
who can get a copy for the class? I know it's something to simply just download.
I can share.
You can share, yeah?
Yes.
Is that like
Shadrach?
just that's Jabayo
It's Shadrach.
or Shadrach, yeah?
Yes.
So will you share later, or you can share now? Do you have a copy readily available?
Let me check my email, but if I won't get it, I will share before the class ends.
Oh, thank you very much, yeah? All right, so Margaret, I've just shared the same Excel to your WhatsApp. Sorry, I thought I'd done that. Just check, it's now shared. Thank you very much, Shadrach. So Shadrach has volunteered to send us the copy of the Public Financial Management Act. That is the law that governs government revenue and government debt. Actually, Shadrach just shared it. So I will share to the rest of the groups also. Shadrach has just shared it. Yeah, so that as an accountant, you must have idea of the accounting recommendations of the PFM, yeah, the Public Financial Management Act, yeah. Of course, if you are to be an accountant in any of our governments or their dissolution, but devolution, yeah, then you must have an idea about public debt administration, yeah. You must know how, for example, the counties manage their public debt. you have no things about where are they allowed to borrow from. What of course authorizations county governments need so that they can borrow. And the same will apply to the national government. Yeah, when you hear of the Euro bonds, the borrowings from China, the International Monetary Fund, the borrowing from the World Bank, all these are governed by the provisions of that particular document that we have shared. Yeah. Yeah, so because your syllabus require you know about public debt administration, then I thought it wise to then share with you that particular act. So you will go straight to the part for public debt management. Please know something about how both the county and the national government manages debt. Yeah, all right. So that we shall not dwell on because that's a read that you guys can do on your own later. All right. Other than that, as you can see, we have 4 more issues of discussion to deal with. One is the taxation of individuals. Number 2, taxation of companies. Number 3, the wear and tear schedules. And then number 4, analysis of variances in budgets. And of course, this one is in the analysis of variances in budgets is with respect to the public sector. Yeah, that's the government sector. Again, taxation of individuals, I will not spend a lot of time on it because that is also relatively straightforward. If you skip to the second sheet, down there you have taxation of individuals. And what you have in that sheet is just but an example of really how salaried individuals are taxed in Kenya. Yeah? Those are not the actual taxation rates. That's just an illustration. Yeah. Of course, where you are to be tested on how you tax individuals' salaries, you should be provided with such a graduated scale rate. Yeah. So you will have such a thing. Whether it's a monthly taxation you shall be looking for, you will have that, or whether it's yearly, that's annually, you will again have a similar thing. Yeah, that is just but an example. The rates change, the rates vary, and so respectively, you will have the right scale rate for calculating an individual's pay. Now, what you need to remind yourself of are the rules in determining what we can call the total taxable income, not profit. Yeah, total taxable income of an individual. If I am salaried, and then apart from the basic pay, there are other incomes which I earn. Yeah. How am I taxed at the end of the day on the gross amount for all this? So you need to remind yourself of really how to come up, yeah, with what is the total taxable income of someone. Remind yourself of that. Then thereafter, you must know how to subject such an income to such a graduated scale rate, which I believe that still you should be well conversant with. Yeah. All right. If I go back to my introduction sheet, then we shall be left with these three matters to therefore discuss in detail together. One is taxation of companies. How do we normally tax companies? Number two is we get to know how to prepare the wear and tear schedules. And then three and last, we get to know how to analyze variances in budgets, of course, in the public sector. Do not worry, it will not be a class until 2 or 3 p.m. like some of you had thought. It will be very short, yeah? All right. Let's go to the third sheet that then talks about taxation of companies. And that's therefore where we begin detailed discussion, yeah? And that explains how in Kenya companies are taxed. And the introduction is very clear that tax payable by a company is what we call the corporation tax. And in Kenya, this is normally at 30% for what we call the resident companies. For the non-resident companies, the applicable tax rate, that's normally a little bit higher at 37.5%. Now, how you then compute the tax that a company should pay is then that second row, that the corporation tax payable is normally what we call the taxable profit, multiplied by the taxation rate, whether it's the rate applicable for resident companies or the rate applicable for the foreign companies. But then one of the problems, which especially for studies you will face, is that what you call the taxable profit, rarely will this be provided directly. Rarely will you have that provided directly. Yeah? A lot of times you'll be expected that you compute it, because what an examiner will provide directly is what we call the accounting profit. That's what we call the accounting profit, and I just want to highlight that. Now, the accounting profit, you have to remember, is the profit that the normal profit that we compute in an accounting P&L, yeah? When we prepare an accounting income statement, which we prepare based on the accounting rules, the profit that we do compute, that's what we call the accounting what? The accounting profit. But then it has to be understood that you cannot work with the accounting profit to then determine the tax liability of an entity. So that even though in accounting we determine the accounting profit, to be able to compute the tax liability, that you also actually minus from the accounting profit in the accounting P&L, then you must always also determine this which we call the taxable profit. It's based on the taxable profit that we are saying up here, that you then compute the tax due or the tax payable by an entity. Let's appreciate what. As an accountant, you must therefore always prepare, or rather always calculate two types of profits. One is your normal accounting profit, which you must compute. But then besides it, for taxation reasons, you must also ascertain, you must also be in a position to ascertain what we call the taxable profit. The accounting profit, we have said, is based on the accounting rules, yeah? And so that based on the accounting standards and what in accounting we call the generally accepted accounting principles, you normally determine the accounting profits. Now, the taxable profit is computed contrarily based on the rules of the tax authority. Like now in Kenya, based on the rules of KRA, you must separately determine the profits on which to compute taxation on. The two profits will not be similar for a simple reason that in a few ways, the rules in accounting differ from, yeah, the rules of determining taxable profit by KRA. You know, you remember that something like depreciation we do not allow for under tax. Instead, we allow for what we commonly call the wear and tear. So for that reason, when an examiner provides the accounting of profit based on a normal accounting P&L, yeah, then based on this formula, you then arrive at what we call the taxable profit. So you will start with the accounting profit figure, to which commonly in taxation you have always said add back, which is never very nice English to me. It is just that you add, yeah. But of course, like you do say that in taxation, add back what is called the non-allowable expenses, and also what we call the taxable incomes not included in the P&L, yeah? Could somebody give us an example of a non-allowable expense? Anyone?
Depreciation.
Yeah, depreciation is one of them. Any other?
Purchase of fixed asset.
Yes.
Purchase of fixed asset.
Yeah. But
Cost.
let me ask you, yeah.
Yes.
In accounting, is purchase of fixed assets an expenditure? Yeah, if one mistakenly treats that as an expenditure,
Yes.
then you have to add back. So that's right, you add it back, yeah. But in a proper income statement, let's appreciate that that's not an expenditure even in normal accounting, yeah. Of course, for lay people, people who don't understand accounting, yeah, then they sometimes do that, yeah. But in a proper income statement by somebody who knows accounting, yeah, something like purchase of fixed assets, that's normally not an expenditure, but all the same, that's fine. If one had treated that earlier as an expenditure, then you would say that that's not allowable, yeah? All right. So of course, depreciation and many more, the amortizations, the losses on disposals, and so on and so forth, yeah? They can be very many, yeah? All right. So once you have added back the non-allowable expenses and those taxable incomes not included in a P&L, you can see that also we need to less what we call the non-taxable incomes, and also what replaces depreciation for taxation, that is capital allowance. So that way, and of course these are things you know, yeah, that way you arrive at the taxable profit, which based on this formula, you can then compute the corporation tax then payable, yeah? All right. On that note, I want us to carry out a very small exercise in terms of that example. Go through that example for ABC Limited. So go through that example, yeah? All right. All right, so hopefully you have read through the question. the question reads that ABC Limited reported a profit of 1 million shillings in their income statement for the year to 2022. Now, this was after accounting for the following. We have those accountings that they did, number 1 to number 6. And then it was agreed with the tax authority that capital allowance be provided at 120,000 shillings for the year. We are then required to do 2 things. 1, calculate the taxable profit of ABC Limited. And then number 2, determine the tax payable. Of course, you assume a resident company, yeah? All right, so we can, besides this, say that we have the solution. And start with part A, which require that we compute the taxable, yeah, the taxable profit. Now, what you need to note is that the question has given us, when you are told of the income statement profit, that's the accounting profit. So the question has given us the accounting profit, which we have been told is an amount of 1 million shillings. Now, for us to adjust it to the taxable, then we have said that we need to add back. There are those items which we need to add back, yeah? So that very quickly, which items do we need to add back? Let me have a few individuals, each of you giving me an item to add back. What is the first item that we add back? Somebody.
Depreciation.
Yeah, so thank you. We start with depreciation. So we add back, not number 1, says that was 200,000, yeah? Another person, what else?
Amortization.
Thank you. We have amortization. And that is 180,000. Somebody else, what also?
Sundry expenses.
Sundry expenses, but on which you have to be careful on how much we add back, yeah? So how much of it do we add?
320.
300 we add back 300 and what?
25.
325, yeah? What was not approved by the tax authority, yeah? Note number 2 is very clear that the sundry expenses amounted to 400,000 shillings, of which only 75,000 shillings was approved by the tax authority, yeah? That means the balance was not approved, and so that's not an allowable expenditure. So we add that back. What else? Somebody?
Disposal loss.
There was a disposal loss.
Yes.
There was a disposal loss, so we add back disposal loss also. Now that was not number 5, in which we are told that this was 90,000, yeah? That was 90,000. Is that all, or we have more?
Donations.
Yeah, so for the, I know for the donations, this is subjective in matters very straight taxation, but let's always note that when it's general, like now this is very general, yeah? We are just told blanketly that we have donations. When it is that general, let's always agree that that's not allowable, and so we add it back. And these ones were how much? 90,000. Were they 90? Sorry, donations were how much? 40.
40.
Donations were 40. Were 40,000. Yeah. Could we be having some more? Anything else, or is that all? That seems to be it for the items which we add back. Yeah. And so what we can do is to, at that point, add them, and so we get that total. Now from this we can then proceed to less. We can then proceed to less. Yeah. And which items do we need to minus? Yes.
Exchange gain.
Non-taxable incomes and capital allowance.
So none, which ones are they? In this question, which ones do we have?
Capital allowance.
Realized exchange gain.
So the most obvious is, of course, the capital allowance. And this we are told in the last info that I want to make that a negative. So I'll put in bracket 120,000, so that that's a minus. Somebody has again talked of the unrealized exchange, gain. The exchange gains, unless they have already been realized, you cannot tax them. Yeah. So that unrealized exchange gain, because you do not tax it, then you have to remove it. Yeah. And this is again, I make that a negative 38. What else?
Reduction in provision.
What?
Reduction in provision for doubtful debts.
Yeah, so you have to remember that in accounting, when you have provision for the doubtful debts, you do check whether the provisions have increased or decreased. In which case, when you have an increase, that's normally an expenditure. And when you have a decrease, that's normally an income. So the company must have reported an income as that decrease in provision for the doubtful debts. Now this being 72,000, yeah? And so that was added to this accounting profit. But of course, we do not tax that. And so we must minus that reduction in provision, for the doubtful debts. And this totals to, again, I'll make that a minus 72,000. And so that is it. If that is it, then we can now compute our taxable income. Yeah, we can now compute our taxable income. And so what we get as the taxable income is that summation, and that totals to 1605 thousand. Yeah, 1,000. So remember that based on that part B, yeah, based on that part B, you can then compute the tax payable. You can then compute the corporation tax payable, yeah? And so that this will equal this taxable profit, we multiply by tax rate, which we have agreed is 30% for the resident companies. And so that is it for how we arrive at what we call the taxable profit. And then secondly, how we determine the tax payable, yeah? Is there any question from anyone?
Yes.
Please
Yes,
go ahead.
Mwalimu. I need clarification on that issue of donations. Is it donations to charitable organizations? Because for donations, I think it's an expenditure that is exclusively to the running of business affairs. So I thought it was to be deducted.
Not really. You know, the accounting profit, which is 1 million,
Yes.
we are told was arrived at after accounting for all this, yeah? All these
Okay.
have been accounted for,
Yes.
meaning that the donations of 40 has
Yes.
already been deducted from 1 million shillings, yeah? So let's be in agreement on
Okay.
that. So you cannot less again. Is that okay?
Okay. Yeah.
Now,
I understand.
matters donation are, and I alluded to this, yeah, before I really had it as part of this working, that I know
Yes.
it's debatable. I know it's debatable, yeah.
Yeah.
Actually, in taxation, you have to remember that we have two types of donations. Those which the tax authority allows that you deduct, and those which are non-allowable, yeah? You remember I alluded to that earlier, yeah?
Okay.
Unless you didn't hear me, yeah?
Okay. Okay.
So I said that in the context of this type of a question, where blanketly, where generally you are told that these are donations, then we shall treat them as non-allowable, yeah? We shall say that these
Okay.
ones are non-allowable, and that's why we have added the back. Otherwise, I do appreciate that there are those which we allow for, yeah? And if that were the case, now for this 40, then we would just ignore the 40 million. I don't know whether I'm making sense.
I'm getting.
All right. Any other?
I have a concern. This is Jabaya.
Yes, Jabayo, you have a concern. What is the concern?
The question is very clear that there 1 million was arrived at after taking care of all these items, item number 1 to 6. So I don't think it's reasonable to again deduct the unrealized exchange gain and reduction in provision because they've been taken care of. The only item which had not been adjusted was capital allowance. So I stand to be guided.
Now, Jabayo, you have to remember, yeah, that in accounting, the exchange gains are incomes, whether realized or unrealized. Yeah, the exchange gains are incomes, whether realized or unrealized. The same thing applies to the reduction. The same thing applies to the reduction in provisions for the doubtful debts. Yeah. If those are incomes, then let's agree what happened to them in accounting. How did we treat them? They were added to this accounting profit. In this accounting profit, we have this 38. Likewise, we have this 72. Now remember, what are we looking for? We are looking for the profits to do what? To tax. In that respect, we must ensure that any incomes, including these ones, any incomes, including these two that you have concern about, we must ensure that any income included in this accounting profit, they are all taxable. They are all taxable. Now, when an income is not taxable, then you have to less. You have to less. That is why in this formula we have said, yeah? In this formula we have said that you less the non-taxable what? Non-taxable incomes. Those are incomes in accounting included in the accounting profit, but which are not what? Which are not taxable. KRA will not tax the exchange gains unless you actually realize and you have received money on them, yeah? Secondly, reduction in provision for doubtful debts. Find that's an income in accounting, yeah? But you realize that it's not a real income. So again, KRA cannot tax that. For that fact that both were included in this accounting profit, but then they are non-taxable. Non-taxable, like we have said here, then of course, like we have done, you then minus the two. Is that okay?
Thank you very much. I didn't really consider them as income in the initial stage. Thank you for the reminder.
All right, all right. Any other concern or any other query from anyone? All right, if there's no concern, then allow me to introduce you to the next discussion, which will be on wear and tear allowance, yeah? So that let's proceed to the next sheet that talks of the WTA, yeah? The wear and tear allowance. Let's go to that sheet. Yeah, now, so the first thing to remember is that we do grant wear and tear on items which assist in running the business. And this is with respect to these assets losing value, one, over time, and two, because of continuous use in running the business. So that this is more of the equivalent of depreciation, which is what we account for in normal accounting. So for taxation to then provide for such depreciation, then we do talk of wear and tear. Now, on the respective assets which qualify for wear and tear, we have specific rates of accounting for such wear and tear. And such rates then classify assets into categories. And in this respect, we have only three categories for granting wear and tear. One is the rate of 25%. So there are those assets which we there are those assets which we grant wear and tear at the rate of 25%. And then those assets which we grant at the rate of 10%. And then those which we grant at the rate of 50%. Yeah, the rate of 50% is not very common for a reason which we'll mention very shortly. Yeah, but just as a summary, the assets which qualify for wear and tear at the rate of 25% includes, number one, all motor vehicles, all vehicles you grant at the rate of 25%. Yeah. Secondly, computers and related attachments, like when you have the softwares, the scanners, now etc. Such will qualify for the rate of 25%, and then cash registers, and then calculators, yeah. So all that qualify for the rate of 25%. Yeah. Now, there are also those assets which qualify for wear and tear at the rate of 10%, which then include all these: the bicycles, the fax machines, the telephones, the curtains, the carpets, the switchboards, counters, the shelves, partitions, the farm machines, the CCTV cameras, the typewriters, the billboards, the signposts, paper shredders, furniture and fittings, the manual cash registers, the weighing machines, and then the trailers. The reason why the 50% rate is not very common is because of the assets to which the 50% apply. Remember, we are mentioning here that the 50% apply to two assets majorly, ships and aircrafts, which are not very common assets. Remember, how many businesses, for example, would have them? Very few. So that's not very common. And again, for the 50%, appreciate that this only apply in the first year of use. Thereafter or subsequent to the first year, you then apply a rate of 25%, which is then on reducing the balance. Now, how do we compute wear and tear? We take the rate for the wear and tear, whether it's 25%, whether it is 10%, whether this is 50%, yeah? We multiply by what is in this bracket. WDA means the written down value. That should be WDV. So that should be WDV, not WDA. Change that to WDV. So written down value at period start. That is the brought forward figure plus any additions, minus disposals. And always note that whenever you start with the brought forward figure, then the method that you use to compute that is the reducing balance. Whenever you start with the written down value brought forward, then the method that you are applying is then what we call the reducing balance. Now, there is then that note on what we have called the additions, and also that note on what we call the disposals. And on the additions, you have to remember that for trade-ins, I believe that we all know what trade-ins are, yeah? Addition is the value of the new item. And by value of the new item, we mean the value of the old item plus the cash you've added. That is the value of a trade-in. A trade-in as addition. And then for hire purchase, addition will be the cash price, not the hire purchase price. Addition should be the cash price. Now, not on disposals, the amount deducted as disposal is the following, yeah? 1, the sale stroke disposal proceed. At how much have you sold? Or number 2, insurance compensation for items stolen or damaged in accident. And then 3, value of the old item for items which are what? Now traded in, yeah? All right, move to the next sheet where very quickly we shall illustrate on really how we prepare what we call a wear and tear schedule, yeah? All right, so that let's go to the next sheet, the wear and tear allowance exercise 1. So let's go to that exercise number 1 and see how practically this is done. So you can read through that question. All right, so the question reads that Lulu Limited commenced business on 1st of May 2022. During the year, the following happened. One, on 1st of July 2022, the following capital expenditure were incurred, so that that should be photocopier, computers all the way to the carpets. And then number two, the company imported a portable weighing machine on 1st of September 2022 at a cost of 480,000 shillings, inclusive of duty of 20,000 shillings. The duty was waived by the government. That is, the duty was waived by the government. Now, what the question requires is that we compute the wear and tear allowance due to the company for the year ended 31st December 2022, yeah? All right. For us to be able to compute, of course, I'll say that we have solution, yeah? I'll say that we have solution. I'll say that we have the solution, and wear and tear allowance we have said is equal to what? You take rate, the rate you multiply by the written down value, the brought forward figure, that is plus any additions, minus any disposals, any disposals. Now, for us to be able to do this, then we shall prepare the wear and tear schedule. So then we shall prepare a wear and tear schedule. Then we shall prepare a wear and tear schedule. The first important thing, remember, is to be able to classify the assets into which ones fall under each of the rate categories. Rate categories, we have said that majorly we have two. One, the 25%, and then number two, we have 10%, yeah? The other one, 50% apply for aircrafts and ships, which we agreed are not very common. Like now here, we don't have them. If that is the case, then per rate category, we shall start with the WDV brought forward. The company's accounting year ends on 31st December, which means their year should start on 1st of January. But you can see that they commenced business on 1st of May, which means on 1st of January, they had not started business, yeah? If that is the case, then it goes without saying that the brought forward balance is a zero. Such a brought forward balance, we have said, we adjust first by what additions have we made. What additions have we made that then increases the brought forward of what? Of zero. The question is clear in note number 1 that on 1st of July 2022, they then purchased all this. And so what I'll do is to copy. What I'll do is to copy. What I'll do is to copy that. And then we shall agree one by one, yeah? Where each of those assets purchased will fall in terms of what their categories. Do they qualify for the 25% wear and tear rate, or do they qualify for the 10% wear and tear rate? The photocopier, this one qualify for what rate? Somebody. The photocopier qualify for
25.
Yeah, that qualify for the 25%. Yeah. So I will say under 25 that we then have this 60. What about the computers? What about the computers? Somebody?
25.
Also
25.
So the 150 will be under 25. Motorbike?
10.
5.
So the
25.
motorbike also
10.
qualify for. Somebody says that 10.
25.
These ones qualify for 25 also.
Saloon car 25.
So the saloon car also qualify for what rate? 25.
25.
But if it exceeds 3
But I
million,
think
it's
for the saloon car, you have to be careful. For the saloon car, you have to be careful because
The engine rating. Engine rating.
because there's a maximum. What were you told is the maximum? What is the maximum that we can allow for?
3 million.
Yes.
3
3
million.
million.
How many millions?
3
million.
Yeah, 3 million. So you cannot provide for more than 3 million. Yeah. You cannot grant on an amount exceeding 3 million. So if that is 3.4, then you have to limit to that maximum of 3 million. Yeah. Where does the forklift fall?
25%.
That is also 25%. Furniture?
10%.
10.
Furniture goes to the 10%. What about the pickup?
25.
That's a vehicle, so that's 25. What about the scanners?
25.
Yeah, being computer related, that is also 25. What about tractors?
25.
Also a vehicle, so 25. And then carpets fall under which category?
10%.
10%, yeah? So the carpets we put under the 10%. The last item is then that in note number 2, yeah? When you go to note number 2, we are told that we have the weighing machine. The weighing machine, which was purchased at a cost of 480,000 shillings, plus some duty of 20,000 shillings. But then you are told that the duty was waived by the government. Now, first of all, the weighing machine goes to which category?
10.
10.
That goes to the 10%. Now, how much do we have in that case qualify?
460.
Yeah.
460.
Yeah,
480.
460. So 480, you minus the duty that the government waived. So you are left with a cost of 460,000. Now, if that is the case, then we are done. If that is the case, then that is it. If that is the case, then that is it. And so we proceed to determine the amount qualifying. We compute the total amount qualifying for wear and tear allowance. And so you will add from the brought forward figure. If in that case you have them, and that's what we get. That's what we get, yeah? With that, we can then compute our wear and tear, yeah? Wear and tear. With that, we can compute our wear and tear due. So how much wear and tear do we then consider due? For the first category, we take the total amount qualifying, that's 67. We multiply by the rate of 25%. And so we get that. So in the same manner, compute for that at 10%. The same manner, compute for that at 10%. And once we have the wear and tear due, then we can compute the written down value, the carried forward figure. And the written down value carried forward figure will be the amount which qualify minus the wear and tear due. So that the written down value end of year, yeah? We have that. So in the same manner, we compute for the 10%, and that's it. That's what we call a wear and tear what? Schedule. That's what we call a wear and tear schedule. So that is there any question? Is there any question, anyone? Yeah, so Sophie is saying in the chat that we repeat on the saloon car, yeah? Sophie, there's not much about the saloon car. When providing for wear and tear on the saloon vehicles, yeah? The maximum you can allow, the maximum cost of it that you can allow for wear and tear is 3 million shillings. So when, like in this case, we were given 3.4, you cannot allow for the entire 3.4. So we have a maximum 3 million. Anything less is okay. Anything less or equal to, that's okay, yeah? More we do not allow. So maximum is 3 million. That is why we have put here now 3 million. So not really much about that, yeah? Is there any other question? Yeah, Amos is asking a question here. Do we apportion for, by that it means, do you apportion the wear and tear for items acquired in the middle of the year? Could somebody answer to Amos? Do we apportion? You see, like the company started trading media, yeah? And so all the assets were acquired media. Do we apportion the wear and tear for the respective months? Yeah? Somebody?
No, we don't apportion. We only apportion in group accounts. Thank you.
All right. Yeah, Amos, you need to interact with so you need to interact with the KRA Excel on filing of company returns, yeah? You do not apportion wear and tear. Wear and tear is in practice provided fully, irrespective of when you have bought the asset, yeah? If your year ends on 31st December and you purchase an asset on 30th, a day to close of year, you will still provide for full wear and tear. When you've bought will not matter, so you do not apportion at all, yeah? At all. All right, any other question? Yes? All right, I want you guys to proceed on to exercise number 2, the next sheet. Proceed on to exercise number 2. That is the next sheet. And in the same manner, I want you guys to prepare that wear and tear schedule, yeah? So proceed to the next sheet and prepare that wear and tear schedule. All right, so the first thing to note about the first thing to note is that now in this second question, we have assets which do not qualify for wear and tear. Yeah, were you guys able to see that? Yes.
Yes.
Which assets here do not qualify for wear and tear? Let me say that the first two do not qualify. Which other ones?
Borehole.
Yeah, the borehole, the staff canteen, the sport pavilion, all that also do not qualify. What else?
Workshop machinery.
Workshop machinery qualify. Workshop machinery qualify. So workshop machinery qualify.
Warehouse.
Warehouse.
Where is the warehouse? Yes, warehouse also does not qualify. So warehouse also does not qualify. So the workshop machinery qualify. I want to think that that's all, yeah. So, and then preparing your wear and tear schedule, please remember not to include them, yeah. Remember not to include them, so that the wear and tear schedule,
But don't they qualify for the 50%?
what qualify for 50%?
The items we're excluding.
50%. Do you know what the 50% category include?
Craftsmanship.
Yeah. The 50% category includes only two assets, yeah? Aircraft and ship.
Mwalimu, what is
Aircraft and
trying
ship.
to say?
Anything else cannot qualify for the 50% wear and tear, yeah? The items we are excluding, I think, What do they qualify for? What do we call it?
BDA
Investment
industrial deduction and industrial
Investment allowance.
deduction.
Yeah, they qualify for the ID mostly, the investment deduction. Yeah. Otherwise, let's not go that direction. Let's stick to wear and tear because that's what you're required to learn. Yeah. So only include what qualify for wear and tear. So the first one is the billboard. The first one is the billboard. Now, billboard qualify for what rate? Is it 25 or 10?
10.
Yeah,
10.
the billboard qualify for 10%. Yeah. All right. This is followed by the computers. This is followed by the computers. That is followed by the computers. So that let me just copy paste all these. And then again, copy paste from weighing machines to workshop machinery. All right, so the computers qualify for what percent? This one we've already seen. Computers go to what category?
25.
Yeah, 25%. So I'll have the value for the computers under 25. Computer software, remember, is the same as the computers. So the 60 under 25. The lorries qualify for what percent? Yes.
25.
Those are vehicles so under 25. The saloon car also under 25, and we now work with that exact figure, yeah? 2.4. The weighing machines we said qualify for what rate?
10%.
Yeah, 10%. 10%. The fax machine?
10%.
Also 10%. The motorbike?
25.
Those are like the vehicles, so 25. The trailer?
The same.
10%.
The trailer?
25.
10%.
10 or 25?
10. 10.
10%.
The trailer qualify for the 10%, yeah? The trailer qualify for the 10%. The workshop machinery, they qualify for what percent? The machinery also qualify for
10.
10%, yeah? The machinery also qualify for 10%. Now the trailer is a little bit debatable, so I don't want to open that window for debate, but find out more about it, yeah? Find out more about it. Of course, yeah, so of course we should have started with the balance, the written down value, balance brought forward. That's where we should have started. The written down value, balance brought forward. That's what we should have started with. So 0, 0 again. And then of course, these ones we say are additions. These ones we say are additions. So amount qualifying for the wear and tear, amount qualifying for wear and tear will be those summations. So that if we add them, yeah, then those are the totals that we get, and on that we can compute wear and tear allowance due at those amounts qualifying multiplied by the rate. So under 25 we get 882,000. Under 10% we get 7,900. With that we can compute our written down value, the carried forward figure, as the amount qualifying minus the wear and tear allowance due, and so that that's it. That is it. That's it. So that is there any question? Is there any question? Now, let me introduce something very briefly as far as the last sheet is concerned. Yeah, go to the last sheet. There's something very brief I want to introduce. Before we look at what that question require, yeah? Where does resource allocation in the government start? For say a ministry to reach the point of receiving money from treasury, where does the whole of that process normally begin? Yeah. Somebody. Where does the process normally begin? Yes.
Usually the ministry presents a budget to the treasury, then it's allocated the amount.
Yeah, so everything starts from the budgetary process, yeah? Whichever government entity it is, you must first prepare the budget, yeah? And anyone who understands government procedures, when does the budget process normally begin? What time of the year? So of course, in a government year, yeah, normally this starts around in which month? Yes.
July or June.
July or June. You have even mixed two accounting years for the government. You know, June is normally the end of one accounting year. July is the start of the next accounting year, yeah? When does the process normally begin? Joanne says 30th June, no?
March.
In March. March is late. You know, the budget is presented in
December.
May, June, thereabout, so it cannot be. It cannot. March.
Come up again with the question.
Yeah.
The question.
When does the budget process begin in the government?
The process starts around October, when the treasury issues a circular to ministries on how to prepare the budget.
Yeah, that's precise. The process begins in late September, October, late September, start of October. That is when Treasury issues out a circular requesting for the process to begin, yeah? And in most government offices, we have a budget office that then oversee the whole budgeting process for a particular government entity, yeah? Through that office, the process is well coordinated between departments in different offices, so that at the end of the day, you have a comprehensive budget for each and every major government office, like say a ministry. So it's based on the budget that you have to remember that Treasury then allocates the ministry money. Whatever money is ministries, for example, receive are not, they are not arbitrary figures, yeah? Somebody does not wake up and say, we shall give the Ministry of maybe Education a number of billions. It's a decision made based on the budget which they have submitted. So at the end of the day, all budgets for all officers are submitted to Treasury, and that's normally what Treasury then presents before Parliament. That's what Treasury normally presents before Parliament. Yeah. Now, that budget is what we do call the original budget. What we do call the original what? The original budget. They initially prepared and of course presented by Treasury before the legislature. That is what technically amounts to what we call an original budget. And in most cases, allocation will be done to these government actors based on that original budget. Now, how do ministries, for example, get additional allocation? What must be done? You know, you realize that like the time of Corona, the Ministry of Health had not budgeted for taking care of the Corona, yeah? So when the Corona comes in and they now need more funds, does somebody just wake up and add the money, or what happens? So again, understands this.
They prepare supplementary.
Yeah, they have to come up with an adjustment budget, yeah? They have to come up with an adjustment budget. They have to come up with an adjustment budget, what we call a supplementary. What we call a supplementary bill. What we call a supplementary bill or budget that must also go through Parliament. Do not forget, for of course approval. And once approved, the ministry or whichever government or state actor then receives the additional funding. Yeah, the original budget adjusted by what we are calling the supplementary bill. Yeah, the original budget adjusted by the supplemental bill then gives us what we call the final. Yeah, the final budget. So the original budget adjusted for the supplemental bills or the supplementary bills already approved is what gives us what we call the function, the final, yeah, the final budget. So let's appreciate that you'll have two types of budgets in this respect. One is what we call the original, and then number two is what we shall call the final what? The final budget, yeah? Now, at the end of the day, based on whether it's the original or the final budget, a ministry then shall actually receive, yeah, the resources then allocated for it. which they will then proceed to spend. To spend, remember, across the fiscal year, across the accounting year for the government. At the end of the accounting year, of course, government entities are also required to do what? Are also required to prepare actual financial statements. So just like private entities, government entities also prepare financial reports. So based on such actual financial reports, you then have the actual data. So such actual data have to be compared with, what we call the final budget. You know, the final budget is normally the most accurate. And when such final budget is compared with the actual data at year end, you may or may not have variations. But variations which are there, you then call them variances. And variances, I appreciate, can be adverse or favorable. Based on such variances, you can then evaluate. Performance. You can then evaluate performance, yeah? And that is what is spelled out in what we call IPSAS 24. IPSAS are the accounting standards which apply for the government sector, yeah? When you are accounting in the government sector, the accounting standards we apply are IPSAS. So IPSAS 24 then governs the comparison of what we call a budget and actual data. So that based on that, IPSAS 24 require that come up with the variances, which based on then evaluate what? Evaluate performance. In that respect, for the variances, you'll be finding out if, for example, you budgeted to spend 1 billion shillings, and then you've actually spent so much, not necessarily the 1 million, then what is the variation which then you experience? And by the way, which is better in the government? Which is better? Is it spending less or spending more? Of course, when there's what we call value for money, when there's value for money, is it better if you spend more or less in the government?
Spend less.
When you spend less.
When you spend more.
Spending more.
Yeah. In the government, note that when there is value for money, when money is used rightly, you are better off spending more. Okay? If you spend less, that means there is a problem. I want you to look at this practical scenario. You are appointed the chief officer of, say, Ministry of Lands in your county, and then you've been allocated 100 million shillings as your allocation for a full year based on what you budgeted. Will your governor be happy if you have spent the money fully, or if you have spent less, so that in your account you still have part of the money? Which is which? Which is which?
Now, Mwalimu, I have a question. Are we talking about a budget or the amounts received? Because if you spent more than the budget, then it's illegal. But if it's about the money, then you spend what you have to the maximum.
I'm now talking about the actual spend vis-a-vis what you've budgeted. If you budgeted to spend so much, and
actually,
allocated money for the budget, when is your, for example, governor to be happy? Is it when you have spent it to the maximum, or when you have spent less?
Maximum expenditure is desirable.
Yeah, so full utilization of allocated funds is normally desirable. When you spend less than the budgeted, that is what in accounting terms in the government we call underutilization of funds. And most bosses in the government sector, yeah, if you are the governor, you'll only be pleased when your chief officer, for example, has spent to the maximum of what was budgeted and allocated, yeah. Less expenditure, meaning that you have saved some money, will not augur well, yeah, with your boss, because that would mean there's something you have not done for the citizenry. Maybe you have not constructed a road or dug a borehole. There's something you budgeted to do, but you have not done it, yeah. And you know, in terms of politics, that would make the politician unpopular, and so they'll not want that. It is therefore preferred that you maximally spend on whatever allocation you have received, yeah. If you can actually spend maximum and ask for more, as long as that can be approved by the relevant approving state actors, in the case of the national government, that's the parliament, or in case of county governments, that's the assembly. If they can approve for more, the better for you, yeah. But of course, one denominator is that there must be value for money, yeah. There must be value for money. All right. Of course, a story for another day. How do we then prepare this variance statement based on a comparison between budget and actual performance? Yeah, let's get to look at that question then in that final sheet. Yeah, let's look at that, the question in the final sheet. Let's get to look at that. Yeah, so the question reads that Elimu Mingi University is a public university based in the coastal parts of the country. And then the following information has been summarized for the purpose of budget analysis. So that's the provided info. We have revenue, or rather before that in columns, we have the original budget, the adjustments. Those are the supplemental bills, the final budget, and then the actual data, yeah? We do have revenue, two revenues, the government grants and subsidies, the internally generated. We then have expenditure, the personnel costs, the management and council expenses, the administration expenses, the students' welfare, the repairs and maintenance, and then the audit fees, yeah? And then we are required to do two things. One, prepare a statement of comparison of budget and actual information as per IPSAS 24. Then number two, provide a rationale explanation where the variance exceed a 10% threshold as per IPSAS 2024, yeah? All right, solution starting with number one, yeah? The solution starting with number one, we want to do a statement of comparison. A statement of comparison. A statement of comparison of budget and actuals, of budget and budget and actuals. So what I will do is to have a column for the budget, and then have a column for the actual. And then when you compare what is budgeted and the actual, the difference is what we call a variance. So we'll need another column which we call a variance. And then the given information number one, we have revenue. So I'll copy that. Now, and just before we proceed to have the figures really, the budget, which one do we work with? You know, we have two budgets. We have the original, and then we have the final, yeah? The budget that always work with, that's the final. Do not work with the original budget. Work with the final, if at all you have that, yeah? Now, the first revenue we are told is government grants and then subsidies. The finally budgeted, we are told, was 832. And then of course, the actual receipt was 810. And then for the internally generated revenue, the final budgeted, we have 1370. And then of course, for the actual, We are told that we have 1220. Let's agree that when the final budgeted is 832 and the actual is 810, the variation is the absolute difference between the two, yeah? Which in this case is how much? What is that variation?
2.
What is that variation?
22.
Yeah?
22.
How much?
22.
Or 22, yeah? Now, when you budgeted to receive 832, now as this university, you budgeted to receive 832, but then you've actually received 810. That 22, is it a good, is it a variance which is nice, really?
It's adverse. It's an adverse variance.
Yeah, so it's an adverse variance. Now, adverse variance is instead of really narrating as adverse or favorable, we can just have that as a negative, yeah? So to have that as a negative, I will take the actual 810, I will minus the final budgeted 832, and so what I get is then minus 22. The minus then signify that that's not desirable, yeah? That's not desirable. That is what that minus signifies. So the same thing will apply to the next one. The next one, which also experiences a negative, and that's now negative 150. And if that is the case, then we can add them. If that is the case, then we can add them. The only two columns I add is for the budget and then the actual, yeah? So that if I add them, that's what I get. You don't need to add the variances. Yeah? All right. We can then have the expenditure. Then have the expenditure info. And so again, I'll copy paste. Yeah, so that again, I can have the figures for the expenditure. So the final budgeted, and then again, I can have the figures for the actual. Yeah, and so if I am to start with the personnel, yeah, the personnel cost, we had budgeted to spend 1370, but then actual spend is 1520. Is that one adverse or favorable?
It's adverse.
Yeah, that is also adverse. Because that's not a nice spend, yeah. If we budgeted to spend 1370, but then we actually spend 1520, that's overspending. That makes that adverse. And so again, to make it a negative, then I'll take to make this a negative, I'll take the final budgeted, I'll minus the actual, I'll have negative 150, and the same will apply, of course, to the last. The last now has a zero variance because the final budgeted is the same as the actual, yeah? If that is the case, then again we can determine the total spend and compute total expenditure. The total spend will be cost those summations. And once we have that total spend, for the government, when we compare revenue against expenditure, yeah, the difference, what do we call it? You know, in normal accounting, revenue minus expenditure gives us a profit or loss, yeah? But the government does not profit. What do we call it for the government? The difference between revenue and expenditure, what do we call it?
Surplus or deficit.
Yeah,
surplus.
Called the net surplus. Or when a negative, that is the net deficit. Net surplus or a net deficit, which to get will be total revenue minus total expenditure. That's 286 for the final budget, and then for the actual, that's 95 negative, which for we can determine a variance also. And this variance will be this actual, the negative, minus the budgeted, the positive. So that's a negative variance of 381. That's a negative variance of 300 and what? 381, yeah? All right. Is there any question on that? That is now the statement of comparison of budget and actual information, yeah? That is what was wanted in required number 1. So is there any question on that, anyone? Before we can look at number 2, which wanted explanation on variances exceeding 10%, variances exceeding 10%, yeah? Now, what IPSAS 24 wants, and these apply in the government, is that once you have computed these variances the way we have, they must be explained. If you are the personnel responsible for any of these items, you must explain why you then have that variation. But then we have a threshold for explaining, because at the end of the day, we only want to explain what is material. And IPSAS 24 identify what is material as anything that exceeds 10%, whether it's a positive 10% or a minus 10%, that has to be explained. So IPSAS 24 then require that you determine the threshold, that you determine percentage, that you determine the percent for each and every variance determined, to then help us explain whichever variance exceeds the 10% threshold. The percentage for each and every variance is calculated as simple as you take the variance. You take the variance, like now for the first item, the variance is minus 22,000, minus 22. I divide that by what was budgeted. So it's the variance in reference to what was budgeted, the variance in reference to what was budgeted. That's about that. Then we can convert to a percent. So that's about, forget about the minus or plus, just look at the absolute figure. The same formula I can apply to the last variance. I can apply to the last variance. So you can see that the first one is 3%, the next one is 11%. So we have to explain anything that is in excess of 10%, yeah? That means we have to explain this 11% and also explain this 11 and 12%. And also explain this 28%. So what will happen will be that the personnel responsible for each of these items must then provide a rational explanation as to why they are experiencing these variations. Why are they then experiencing now these variations? So the officer in charge of, for example, internally generated revenue will be asked why they then had the 11% variation. Negative means below the budget in terms of what's desirable, yeah? Below the budget in terms of what's desirable. You see, like for the internally generated revenue, we had planned to collect 1370, but then we actually collected 1220, yeah? So the officer in charge must explain why they then have that that less actual collection compared to what was budgeted, yeah? So if we take, if I say that we have item, I can say that we have item. The item is, the first item is the internally generated. And then you need explanation as to why that negative variation occurred, yeah? That you have to do as the person responsible for the internally generated revenue. So could somebody help us understand what could be, what for example could be the cause of that negative collection in the internally generated revenue? First of all, what are examples of this internally generated revenue for, this one is a public university, yeah? Why would
That's college fees.
the public university have, okay, what examples do we have for the internally generated revenue?
Student fees.
Students' fees, which one? You have to be careful on that, because actually most school fees that public universities receive normally from the national government, yeah? That is for the job students. They are actually what we call the government subsidies. You know, the job students pay less fees because the government subsidizes their school fee. They pay very less. So up to 90-something% of their school fees, the government pays the universities in terms of what? Subsidy. So which school fee are you talking about here for the internally generated?
Module 2.
Yeah?
Yes, sponsored.
Yeah, the self-sponsored students. That's okay. That now becomes internally generated. What else?
Research.
Property rates.
Yeah, so not necessarily When you say property rates, you will be misleading. And I don't know whether you mean the fees they receive on maybe intellectual properties and those kind of things. Yeah.
Yes.
Yeah, on research and so on and so forth. You know, for one of the policies that we had introduced, I think in the time of the Kibaki government, is most parastatals ensuring what we call self-sustenance. It is just bad behavior that in Kenya this does not happen, yeah? But when you go to like the developed countries, universities, for example, should generate more from the activities than what the government gives them. That is for self-sustenance reasons. So that you should not hear of incidences of delay in salaries, lack of money to pay part-time lecturers and such kind of social vices, yeah? That happens in Kenya because our parastatals do not self-collect their own revenues, yeah? Which is not very nice. But if that policy were to be followed, yeah, then of course even the universities should be able to really take care of their costs, even without money from government. It is more of a laziness and lack of the goodwill to think, because universities can make a lot of money. You know, it's in the universities where we are taught how to do business and make money, yeah? So it becomes laughable when themselves they struggle. When themselves they struggle, it becomes laughable. That's where you are taught about financial management, business planning, and those kind of things. Then they go behind our back and now still struggle financially, yeah? So really they should be able to do business. I'm privileged to have schooled at the University of Nairobi, and in the campus I was, they do a lot of business, yeah? You find them selling yogurt, they produce and sell ice cream, they do a lot of agriculture, they have so many acres of lands and crop production, they do animal production. Yeah, but seemingly still for them, that's not enough. So the possible reasons for less collections internally in terms of the self-sponsored students, you could explain that this is due to less number of self-sponsored students compared to expected. Of course, there are so many reasons for this. So etc. Yeah, there are so many reasons for that. If it's a university that carries out agricultural activity, like say Egerton, that focuses on a lot of agriculture, you can talk of maybe poor climate leading to less production and so less sales, hence the less internally generated compared to what was expected, yeah? So that's on the revenue. One of the costs is personnel. So we'll explain the personnel because that's a cost. The first one was a revenue. Why would the personnel cost, when you look at the personnel, the budgeted was 13, the actual is 15, so they overspent. Why would we have an overspending on the personnel costs? Somebody. Why would we have overspending on the personnel costs? Somebody. Yes.
retrenchment costs.
So
Costs
explain.
of, retrenchment.
Yeah.
Yeah, so maybe if we have unplanned, this was not planned, but for some reason, because of maybe a new government regulation, you have the national government forcing a retrenchment where they are due, then that could lead to more costs of personnel than was anticipated. Anything else, somebody?
Legal fees in terms of suits allowed by employees.
Yeah, so the issue of legal costs on employee matters, again, that would be unforeseen. If that actually happens, then the actual costs of employees could be high. Remember, and so on and so forth. So in the same manner, you shall explain the rest. In the same manner, you shall explain the rest. So the solution to number 2 should therefore be in that manner, yeah? The solution to number 2 should therefore be in that very manner, yeah? All right, so that's it for that question. And unless somebody has a question on this, then that is it for the comparison of budgets and actual, yeah. All right. Any question? Is there any question? Yeah, no question. Yeah. Now, one more thing that I think I'm forgetting. One more thing that I am forgetting, and that you can add under the subtopics number 6, is that this one will just mention, there's not much about it. Just have it in mind that it's part of this. Financial statements analysis. Financial statements analysis. Analysis in public sector, yeah. Yeah, so financial statements analysis in the public sector, yeah. What I wish to remind us of is that in the government entities are required to prepare financial statements. Of course, just like we do in the private sector. So that if you're the accountant of Nairobi County, you will have to prepare financial statements just like private sector entities also do, yeah? And the financial statements, the most common financial statements in the government include, number 1 is the income statement. The income statement, what will be commonly called the statement of financial, the statement of financial performance. And then secondly, we also prepare the statement of financial position. The statement of financial position, which is the same as the balance sheet. So they are also required to prepare financial reports. And I am saying that the most common financial reports are these 2. In the government, financial reports are very easy to prepare. So I do not want to again dwell on that, because that should be a very easy task for you people, yeah? You must have done IPSAS number 1, preparation of financial statements in the government is governed by IPSAS number 1, yeah. Presentation and disclosure of financial statements in the government, yeah. So that's IPSAS number 1. So the preparation of these two should not be an issue. Given info about, say, a government ministry, that should not be a problem doing, yeah. All right. So one more thing that you are required to do is to know how to do financial statements analysis. Then in the public sector, yeah, are you able to analyze these two reports based on the analysis tools, which we have already covered, yeah? Remember, I have taught you that financial statements analysis is done based on two tools. The class B, don't worry about this. The class B, do not worry about this. We'll have that done, but I think that we covered in, last Sunday. So both of you have covered this. Financial statements analysis can be done based on two things. One is based on ratios. So given the income statement of, say, a ministry, are you able to compute various what? Ratios. So you must know the ratios formulae, which we have already discussed, yeah? And then secondly, financial statements analysis can be done based on what we call the common size, financial statements or financial reports. We can do that based on the common size financial what? Reports. I want to believe we covered this last week, and so this should not be an issue, yeah? So if you have to analyze public sector financial reports, financial statements, then you have to remember that these are the analysis what? Tools. We have covered both, and so again, that should not be an issue.
Where did you cover this?
Last Sunday.
So trend analysis is not applicable in IPSAS?
Yeah.
I'm asking trend analysis, it's not applicable in IPSAS?
No. Trend analysis is mostly for the public sector, yeah, not private sector. So there's the B class. There's the B class in the whole of this lot. These are a mixture of classes. So the B class, we still have about 3 lessons to finish what remains. So we still have something to cover. The A class, you know yourselves when I say B and A, the A class, that will mark the end of your syllabus. The A class, yeah, that will mark the end of your syllabus. The B class and the NTC, you know yourselves. We still have something to cover, and this we shall do. So no worry, that we shall do. Now, next weekend, yeah? Next weekend, the A class, we are meeting tomorrow. Do not forget we have a class tomorrow, because I think there is still some small element on consolidation we are to complete on, yeah, before we actually call it a semester. That we shall do tomorrow, the A class, the consolidation, the incomplete part we shall finish tomorrow. So the B class, we still have about, the B class, you have to note that the A class we shall meet tomorrow, and then we shall not meet on Wednesday. So the B class, you are required to come to school on Wednesday, so that I'll meet you on Wednesday and then Thursday. I'll meet you on Wednesday and then Thursday. Yeah? NTC, our next meeting will be next week on Sunday. Yeah? Next week on Sunday. Now, coming Sunday, I will offer a revision class. Coming Sunday, I will offer a revision class. This is all inclusive. I want everybody on the board. It will be pure revision on a few selected areas. Yeah, that class will start at 9 and will end at 2. That revision class will start at 9 on Sunday. It will end at 2. So it's for everybody. Next coming Sunday. Yeah. So please plan to be part. It's not a must because the syllabus is whatever I'll revise, we have already covered that. If you are busy, you can also miss, but it will be a class which is open to